So when we get our eligible investment and expenses amount, finally by comparing these three, we need to multiply a percentage to get the actual amount of investment tax rebate. So you need to keep this slab in your mind, like the tax rate. One thing I need to clarify, that is the slab is based on the taxable income, based on the total taxable income. So if my total taxable income, remember, when you see the total income in tax document, you need to understand it. It is referring the taxable income. It is not including any tax exempted income. Okay, it is always total income means here it is always, you need to understand it like total taxable income. So if total taxable income of an SSC is within 15 lakhs or maximum 15 lakhs, okay, in that case, out of his eligible amount of investment and expenses, 15% will be rebate. If his taxable income, total taxable income exceeds 15 lakh, then eligible amount of investment multiplied by 10% will be his investment tax rebate. So in previous session, we are solving a problem for an SSC. So here we, can you recall that that person had total taxable income of how much? This number 3,775. So can we say that this person total taxable income is within the range of 15 lakh? So in that case, for this person, which percentage will be applicable between these two, 15 or 10? As this person total taxable income is within the
15%.
is within the 15 lakhs, that's why the eligible percentage we applied is 15%. So what the thing I like to stress you, you need to get this percentage by looking at the total taxable income of the SSC. If the situation is like that, that this person total taxable income is like this figure, okay, now it is how much? uh, if I like this 2 million something, 2 million something means it is above 15 lakh, is it?
Yes, sir.
It is above 15 lakh. In terms of lakh, it is 23 lakh. Okay, in that case, what would be the percentage for this eligible amount of investment for getting investment tax rebate? In this case, the percentage will become 10%. Okay, so you need to keep these things in your mind. And another thing, that is the issue that I like to make it clear related to previous session. And another issue that is, I referred you to check the items on which investment allowance is available, then the income on which tax is exempted, and the calculation of this thing, what we just have made, investment tax rebate calculation. I suggested you to check it from the Bangladesh income tax textbook by Nikhil and Shil. Uh, However, if you can't manage that text immediately, what can you do? You can follow or you can check the chapter 13 of the Bangladesh income tax planning and compliance book, which is published by ICAB, which we are following mostly. You can look at the chapter 13. Let me confirm it again. Yeah, chapter 13, you will see that which items are eligible for getting investment tax rebate. and which income are tax exempted, and how can we compute the investment tax rebate, these things. Okay, so most of the things are commonly available in both books which we referred or which we are following. But for practice purpose, you will get the text of Nikhil very helpful, because a good number of problems are available there. So for example, when we took a problem in previous class to solve, that is from Nikhil text. So for more practice, you can see the text from Nikhil to practice the problem available there. Okay. So in today's session, what we like to concentrate, that is income from interest on securities. And in second part of our session, we like to use our available time to understand this concept, set off and carry forward of loss. I will explain it later. What do we mention or what do we mean by this? Remember, section 21 of income tax ordinance has been devoted for understanding income from salaries. And for example, if you like to ask me that what is the law reference of the salary particulars, what we are doing right now, what is the original source? Okay, the answer is that this income tax ordinance and section 21 mentions those items which need to be shown as salary income. Now, if you like to ask me what are the how can we get the uh, tax exempted amount from income from salary, you can still get the reference from here. So if you look at the section, for example, where today we will try to discuss about the set off and carry forward of loss, you immediately can observe that this is will be from section 37 and section 38, and there are other additional sections devoted for set off and carry forward of loss. So right now we like to concentrate on income from interest on securities. Uh, so based on this, you see a chronology like in a, for example, the income heading starts with salary. If you look at the heads of income, I can't recall that whether I have mentioned it to you earlier, that these are known as uh, head of income or income heading in our income tax area, that people have income from these common sources. And most of the people, almost all people, income can be classified into these 7 headings. But in recent year, 3 additional headings have been included, which has not been still updated here. That is kind of income of a spouse, then income from uh, foreign business, like these things. So right now we have, if anyone asks you how many heads of income you have seen in income tax ordinance or in your business taxation class, the answer is 10. There are 3 additional heading uh, on top of this 7. So up to previous session, we spend time to understand the salary. In today's session, we'll like to understand the income from interest on securities. So other than these two, there are income from house property, income from agriculture, income from business or profession, capital gain, income from other sources with respect to personal income. But thing is that as our course title is business taxation, we like to spend less time on personal taxation or individual taxation. So from personal income perspective, we like to concentrate on the salaries and the interest on securities. And we like to spend one session at least income from business or profession. Then we shift to the company income, value added tax, customs duty, if we can use our remaining time. Okay. So matter is that what will happen if you see the income from house property or agriculture income, capital gain, or income from other sources for your SSC. The thing is that if you get the structure of other 2 or 3 headings, what we are right now discussing, you get a common structure, you get a general format that what will happen to other heading. So for your own purpose of interest, what can you do? You can check the respective chapter or respective section and you can solve your problem. But for our course purpose, I mean for our semester exam and for our module design, if you look at the course outline, you would probably see the income from house property, but we have decided not to cover the income from house property, rather spend more time on the business taxation and the company taxation, and we will also cover income from business or profession. So though income from house property is available in your course outline, we will try to skip this. Okay. But in after finishing our intended uh, chapters or intended sessions, if we have the available time, we will try to get back to begin from income from house property in extra time. Okay. But another thing I like to stress is that, uh, for example, income from other sources, that is a very general listing. For example, if I like to give you an example, that you see that people earn income from participating in talk show in TV, on TV. Okay, that is one example that which you like to you have to include in the income from other sources. Okay. Then if you ask me that I receive dividend from my investment uh, in stock of a particular company, so in which heading I need to show that income, dividend income? That is very common. Okay. The answer is that is in income from other sources. Okay. So keep these things in this point. We like to concentrate right now on income from interest on securities. Okay. So we will try to follow the explanation of income from interest on securities from the ICAB text. The chapter devoted for income from interest on securities, the chapter number is chapter 5. You would probably see the chapter is mentioned in your course outline. So income from interest on securities in most of the families, uh, not most of the families, or you can also say for most of the families, you will see that income from interest on securities is available there. So the question is, what income tax ordinance means by the income from interest on securities? So what kind of interest income they like to include? So the answer is that uh, from your finance courses, you already have come to know that there are some securities which are fixed income securities, of which example is or we generally know those kind of securities as bond. Okay. Where the interest rate is fixed interest income is available. So in some religions it is not prohibited But in Islam religion, interest income is strictly prohibited. So for some people, you will see they are Muslim, but they are reluctant to maintain this prohibition. They earn interest income. So in that case, to show their interest income in their income tax return, you need to know that how you can present their interest income, or any SSC who have the interest income in the income tax return. Okay. So in general, if I like to write in bold, in general, government and there are other parts also. For example, municipal government also available there. Then companies can issue the fixed income securities or bond in general. So in their bond or fixed income securities, interest income is available. So other than interest income, there is a possibility of getting capital gain also. Okay. So capital gain from these securities are not to be included in this heading. Okay. Though the interest and capital gain both are generating from single same instrument, obviously your interest income needs to be included in this heading, but not the capital gain from this investment. So who are the issuers? Issuers can be government, issuers can be municipal government, issuers can be corporate entity, these things. And you probably have heard about the coupon bond, you have heard about the zero coupon bond, and you know very well in zero coupon bond, as the name implies, there is no coupon or there is no interest income. But one thing just will be crippled in your mind, that is, we earn interest income from our bank deposit. Is it this heading where we will show the interest on bank deposit also? The answer is no. It is not that heading where you will show the interest on bank deposit. So the follow-up question is, in that case, where we'll show our income from interest on bank deposit? The answer is the income from other sources. You just have seen the heading income from other sources. In that heading, you need to show the income from interest on bank deposit, income from interest on FDR, income from interest on DPS, these things. Okay. Now, one common interest income available in available at home of Bangladeshi people nowadays is the income from interest on saving certificate. Saving certificate periodically pays interest payment. That is the income to the person who has bought the saving certificate, and this saving certificate interest income is to be included in the income from interest on securities. Okay. So though the name implies that it is a kind of certificate, but in finance term, it is a kind of government bond. Okay. The periodical coupon payment is available here. You are purchasing it as a value and you can sell it. There is a fixed maturity, that how long it will continue. So you, I think you have got an idea that what kind of income will be included in the income from interest on securities. Okay. Now, thing is that, is there any tax exemption facility? So the discussion what we just have made, you will see the summary here, that interest receivable by the SSC on any security of the government or any security approved by the government. So for example, government's corporate securities, you need to take approval from the capital market authority to issue the bond in capital market or for long term. And for short term also, you need to take permission from the appropriate authority. And interest receivable by him on debenture, you probably have heard about the debenture, that is in between equity instrument and the debt instrument based on the feature of the debenture. Is it? Have you heard about the debenture?
Yes, sir.
How it is different from bond?
স্যার বন্ডে জামানত লাগে আর ডিবেঞ্চারে জামানত ছাড়া হচ্ছে হয়
Okay, so which one is more riskier
Bond.
for the buyer?
Debenture.
স্যার
Debenture, yeah. So it is riskier than the bond. Okay, so it can be issued by a local authority. Can you recall that I have mentioned the municipal government? So here local authority means municipal authority, or it can be issued by a company also. Okay, so I don't know whether you have heard it from the newspaper of last 2 weeks, that Dhaka North City Corporation has decided to issue municipal bond for the first time in the Bangladesh history. So if they get their application approved, the bond issued by the Dhaka North City Corporation will be the first municipal bond in Bangladesh. Okay, as the Bangladesh is not a very big country, that's why local authority are almost dependent on the revenue from the government. Their generation of their own revenue is not to that extent. But in case of other countries where the, for example, India or US or China, their local authority is much relatively more dependent on their own income. They issue their security when they need to raise a fund to meet up their expenses, to meet up their development expenses. So municipal securities are mostly commonly available there, unlike Bangladesh. Okay, so one thing you need, you can keep it in your mind, that Dhaka North City Corporation has applied for issuing bond. So if you are fortunate, you will see a municipal bond has been issued in Bangladesh in your lifetime. Okay, so the follow-up question, as you already have got the idea that which income will be included in the income from interest on securities, I just like to conclude that discussion just by saying that there are one classification you will see from your text, that is kind of that based on the purpose of the SSC, the securities can be classified into 3 headings. You are very likely to see this kind of classification from the financial accounting module of your financial accounting 1 or 2. One classification you can make, that is the trading securities, or more formal it is known as held for trading. And another classification in extreme, you will see that for the purpose of held to maturity, and there is another classification in between two, that is known as available for sale. So for financial accounting and the financial reporting purpose, knowing these concepts and how to value these securities based on this classification is more important. But for our purpose, just to know the concept that uh, which are trading, or what is the purpose of what purpose does it serve by the held to maturity, is sufficient. For example, uh, if you are an SSC, or if you are a person like this, that you buy the securities to hold it for very short term, and you like to generate profit not from interest but from capital gain by buying and selling within a short possible time, buying and selling. uh, when your purpose is buying and selling, you can immediately recognize that it will not be possible for this person to have the interest income uh, or the dividend income in case of equity securities, because this person is continuously buying and selling. So you can recognize that this person purpose is not to generate the current income, rather this person purpose is to generate the capital gain by buying at a low price and selling at a higher price. And it is a kind of riskier activity for any person, that you are buying and selling and you are holding the security for short term. And people of this kind of nature are commonly known as trader, not the investor. They are commonly known as trader because they buy and sell the securities in a very shortest possible time to get a favorable price, or to utilize the favorable price in their purchasing. So if any of your security of, or if a particular value of your security holdings of, or percentage of your portfolio you have devoted for trading purpose, those securities will be categorized in this category, that is held for trading. Okay. So next one is I like to start from here, held to maturity. So it is just the opposite of this one. Held for trading is just on the reverse side of the held to maturity. So instead of buying and selling in a short possible time, you like to hold the security till maturity. So for example, a particular security maturity is 15 years. You like to hold that security till 15 years. So you can immediately recognize the purpose of holding this security is not to generate the capital gain, rather earning interest income by holding the security till the maturity. So an SSC may have some securities of which he is not clear, or he has not made it clear that whether I am keeping this security for trading purpose, or for I will hold this security till maturity. In that case, the securities are not included in trading, are not included in held to maturity. In that case, those securities will be included in available for sale category. Okay. So that is our understanding of how we can classify the securities based on the purpose of based on the purpose set by the buyer, or in our context set by the SSC. Okay. So you will ask that whether there is any tax exemption on the interest income SSC earns on by interest income. The answer is yes. There are some tax exemption facility, that out of some income you can have some tax exemption of a portion of income. So how this exemption or income exemption or tax exemption applies when the income is interest income. Okay. If you are not or I think in my class there are some people who have used their bank account in a reference account for the saving certificate their parents have bought. So when the interest income generated, your bank account credited for that interest income. So I think there are some people like those in my class, and there are some other people also who have purchased share in a stock market, and when their issuing company pays dividend, their bank account gets credited for that dividend income. So you will see that bank which is collecting interest income on the securities which SSA has bought, bank is charging some collection fee for collecting the interest income accrued to the SSA. Say for it is a kind of percentage. It can be on a percentage basis or it can be on a fixed amount basis. Okay. So the good news is that the bank charge for collecting the interest income is tax exempted. That means if you have a interest income, for example, 1,000, and it has been mentioned that bank has charged 10 taka for collecting this 1,000 interest income, in that case you will get exemption of 10 taka. In that case, what will be your taxable income, interest income for this 1,000? The answer is 990. So you can recognize that this number is very small. You don't mind if you pay interest on 1,000 taka. Okay. So the answer to you is that it can be figured like this: 1,000 million and 10 million, 990 million. Okay. In that case, you can immediately recognize that how worthy this exemption is to you. Okay. So you have got one point that which by which you can get the exemption from your interest income. Okay. So you see from the income tax ordinance reference, what we are trying to see, the allowable allowances and deduction. Allowable allowance and deduction. So what is the answer? The any sum deducted from interest by way of commission or charges by a bank for what purpose? For realizing the interest on behalf of the SSC. So I think you have got it. Okay. Second one is, it may be such that for investing in interest bearing securities, you have taken a loan. You have taken loan. You probably have heard about the margin loan, right? Have you heard about the margin loan from your finance course? Or I think you will get it in your investment course in your third year, second semester. But okay. So what is the thing? The thing is that for making investment in financial market, you can, it is likely that investor also take loan in addition to their own money, and by taking loan and by adding this loan amount with their own balance, they purchase the security. And the what is our purpose here? Our purpose is that interest expense becomes due for that loan, what you have taken for what? Buying the interest bearing securities. Which securities? The securities which are allowable to be included in the income from interest on securities. Okay. So that interest charge by the bank is also to be deducted from your interest income. For example, by having a amount of loan, you have purchased an amount of security, and from that security you have generated 10,000 taka income. And the loan what you have made for investing in that security, in that loan, say 500 interest has been charged in a particular income year. So it is said that that interest income can be subtracted from the respective interest income. Which interest income? Interest income of that security which you have bought with the loan amount. Say you have bought this security with the your own money. In that case, it is not applicable. But in case of the investment, when you have made it also with the loan, that interest on the loan is also to be applied here for allowance purpose. So in that case, your tax liability will go down. Now, there is a caution that regarding this allowance. So what is that caution? That caution is like if you have bought a loan, you have taken a loan for buying a security on which interest income is tax exempted. Say government security. Some government securities are fully tax exempted, like treasury bill, fully tax exempted. But there are some government securities which are taxable. So what are those examples? Savings certificate is a instrument, is a security issued by the government, but it is in the taxable category, not tax exempt category. So if you take a loan and buy tax exempt securities, the interest income on that loan will not get the facility of tax exemption what we just have understood. So in which case it will be applicable only in case of taxable security. In case of taxable securities, only the interest income and the collection charge are allowable to deduct. And also the collection charge for interest income on tax exempt securities will not be allowable expense. Okay. And there are some securities what we have mentioned previously in our discussion, that it can be like commercial securities. Okay. Or you can know as corporate securities. So in general, corporate securities can be like debenture, it can be like bond, it can be like zero coupon bond. Okay. So some securities can be approved, some securities can be like that. Those are not approved by the government. Okay. In that case, if it is not approved, in that case, you can't get any exemption. Okay. But what we like to say that in government securities, though we are saying taxable, some securities are taxable like savings certificate, but you need to recognize that some securities, specifically government securities, are though taxable but taxed at a reduced rate. taxed at a reduced rate. For example, in savings certificate, 5% TDS is applicable, and it is said that this 5% is the final tax on the savings certificate interest income. This 5% is the final tax liability on the interest income of the savings certificate. So some people in our country misunderstood this rule. So how they misunderstood this rule? In a way, they think that as I have paid 5% TDS on the savings certificate interest income, so I do not need to show this interest income from savings certificate anymore in my income tax return. They don't show their income from interest on savings certificate in their income tax return, but that is not the right way. The right way is that you need to show that interest income in your income tax return, and you need to adjust your tax liability by telling that the 5% TDS what you have paid is the final. So when you will calculate your total taxable income, the interest income from savings certificate will get excluded from here. Then you will calculate as usual taxes on this available income on which regular tax rate is applicable. So the regular slab will be applicable for other income, but for specifically it is known as 82C. 82C, the income on which reduced tax rate is applicable. You can recall that in investment tax rebate calculation, in number B, there is a specific mentioning in the parenthesis that excluding those income on which reduced tax rate is applicable. You are getting the example here. Okay, this is such kind of income on which reduced tax rate is applicable. Okay, so there are some securities in our country on which though they are bond, but government has said that those interest income from these securities are tax exempted. So what are those securities? If you read the newspaper, you will see this kind of securities name: wage earners development bond, US dollar premium bond, US dollar investment bond, euro premium bond, then euro investment bond, pound sterling investment bond, pound sterling premium bond. These bonds are interest income from this bond are tax exempted. And these bonds, remember, these bonds are issued by the Bangladesh government, okay, but in foreign currency. So what I like to stress you that you will try to see that what is the difference between foreign bond and the euro bond. Okay, you will see the difference between these two and understand this difference. And the bond what I just have mentioned, like US dollar premium bond and pound sterling premium bond, then euro premium bond, you like to understand that in which category these bonds will fall into. Okay, so you'll explore this. I'm not mentioning what is the difference between these two, but that is important to know. Okay, so before checking a practice problem on income from interest on securities, I like to let you know a way, a path people use to evade taxes on interest income or avoid taxes on interest income. Okay, so let's see. You probably have heard about these two terms in your financial management course: cum-dividend and ex-dividend. Can anyone respond that I'm correct, that I am claiming that you have heard this term, cum-dividend, ex-dividend? Just yes or no that your class has heard about this term.
স্যার আমরা এই টার্মটা পড়ি নাই এখন পর্যন্ত।
Okay, you are right now taking the financial management course in, or you already have taken?
So already have taken in last semester.
You had a chapter like dividend policy.
Yes, sir, we had.
So if you had a chapter like dividend policy, it is very likely that you need to see these two terms, cum-dividend, ex-dividend.
So is it cumulative dividend?
Cumulative dividend, no, not in no, not in terms of cumulative. Okay. And in also your fundamentals of finance, you also are very likely to learn about this. Okay. Have you heard about the record date?
Yes, sir.
In which course?
So it was in first semester, principles of finance course
Okay.
naam to sir.
So yeah, if you heard about this record date, it is very likely that you have not heard about the record date without these two terms. Okay. So whatever, I like to tell you that say Grameenphone has declared that record date is 15th December. 15th December. So what does it mean? It means that the investor who will buy the Grameenphone share till 14th December, they will be entitled to get the dividend Grameenphone is planning to pay in this declaration, based on this declaration. So up to this date, 14 December, I mean before 15 December, before record date, on record date, there will be no trading. So there is no chance to buy and sell on this record date. On record date, the trading is halted. Okay, that means the trading is postponed on record date. So on 14 December, it is likely that not it is likely that if you can manage to buy the Grameenphone share within this date, I'm not taking the complexity of T+2 trading day requirement. That means how long it takes to settle or how long it takes to credit your BO account by the share. So I'm assuming that it is immediately recorded, but in our country it takes T+2, that means trading day plus 2 days to get the share credited to your account after having bought in a particular day. Okay, yeah, on the date in which you have bought, that is the trading day. Okay, so Grameenphone share will be known as cum-dividend till 14 December. Now after 15 December, on 16 December, Grameenphone share will be traded at a ex-dividend price. Ex-dividend price. So what does it mean? It means that say that Grameenphone was trading at 330 taka on 14 December. if it is like that, the dividend what have been declared, that amount is, for example, 30 taka. So when in 16 December Grameenphone share will be opened for trading, you will see the open price adjusted like this:
300,
330 minus
300, 30.
30. You will see this price. That is the open price adjusted. So I think you have got the meaning of cum dividend, ex dividend. Okay. So here cum dividend means with dividend, ex dividend means excluding dividend. So I am erasing this dividend concept, dividend wording. I just like to add here the interest, cum interest and the ex interest. Okay. So say there is a due date for interest payment like this record date. So what does it mean? On the record date or on the due date, in interest income, there is no record date. Here we say the due date. Say in your financial management bond valuation problem, you would see the interest income is due like this. For example, every 15 December interest income is due, and or interest income is quarterly paid, and in every quarterly month, 15th day of the quarterly month, interest income becomes due. So if you understand the cum dividend and ex dividend, what you will understand right now immediately, that if anyone buys the interest bearing securities on which interest becomes due on 15 December, he will be entitled to receive the interest income if he has the interest bearing securities in his account before this date. Say Mr. A and Mr. B. Mr. A has this interest bearing securities on this due date. In that case, Mr. A is entitled to get the interest income which has been due on this security. If it is like that, that same security has been bought by Mr. B on 16 December. Now, can you tell me the interest income which was due on 15 December will be available for Mr. B?
Sir.
Will be available for Mr. B? He
No,
is
sir.
planning to buy this on 16 December. In that case, Mr. B is not entitled to receive the interest income which has been due on 15th December. Have you got it?
Yes, sir.
Okay. Now, let's say, so there are some terms to identify this date. Say, if I write this date, for example, 14 December, you need to understand this date in this way, that it will be known as last date to register. Register where? Register on the book where it will be decided that this person, this investor are entitled to receive the interest income. Okay. So say, what does it mean? That means up to 14 December, you can buy and you can get yourself registered on the book so that you will get the interest income. But on 15 December, when it has become due, it will not be available because it was the last date to register. It was last date to register. Okay. Now the thing is that what term we will mention for this date? This is known as BCD. So what does it mean? It is known as books close date. So that means on this date, no one will be entitled to receive the interest income which has been due in the on this date, unless he or she has already been registered within this date. That was the last date to register. Now, the period after 15 December is known as ex-interest period. Ex-interest period. So, if I like to tell you that interest income becomes due on in every 3 months. So, this is one date. What is the date 3 months before this 15th December? 15th September, is it?
Yes, sir.
Then what will be the next coupon date? 15th
15th March,
March. Then 15th
June.
June. Okay. So you can identify that it is the last coupon date. It is the next coupon date if you are right now here. Okay. So now you have got the structure that who are entitled to receive the interest income, who are not entitled to receive the interest income, to get the interest income or to get the interest on a particular date or on a due date, before which date you need to buy that security. Okay. So the thing is like that. Before telling you that how interest can be avoided by the interest earner, say when I say the 15 December is the interest due date, interest income due date, it means that from the 15th September or not from 15th September, after 15th September to 15th December, there was a 3-month period. There was a 3-month period. So a person who was holding the security during this 3 months, actually he is entitled to receive this interest income which has become due on this 15th December. So if it is such that Mr. A has sold this security to Mr. B on 15th October. Remember, on 15th October, Mr. A has sold the interest-bearing securities to Mr. B. In that case, can you recognize that a portion of the interest income which has become due on 15 December, a portion of that interest income is due for Mr. A and another portion is due for Mr. B?
Yes, sir.
Because 3-month period, this total 3-month period has been divided into 2 parts because there was a transaction between A and B in the meantime. So in that case, you can clearly know that how can we determine the portion attributable to Mr. A, determine the portion attributable to Mr. B. So that is not part of our discussion. I just like to add additional part so that you understand that it is not likely that transaction will be made only on the interest due date. It can be available either on due date or before or after due date. So what I like to tell you that how to avoid the tax on interest income. Okay. So the scenario is like this, which is known as bond washing transaction. Bond washing transaction. For example, a person has total income of 2 million, total taxable income. Without considering the income from interest on securities. Okay. And think of another person who has income of only 200,000. Of which person the average tax rate will become very high for this person?
Yes, sir.
Yeah, you know, when I say the average tax rate, what does it mean? It means that when you are touching the slabs of the tax, for some portion of income you get 5, for some portion you get 10, some portion you get 15, some portion you get 20, like this. Can you recall?
Yes, sir.
The tax rate? Okay. So for a person, if you calculate the net tax liability like this, net tax liability, it is not the summation of percentage. It is not the summation of percentage. Remember, I am mentioning here net tax liability in taka amount. And if you divide this number by the total taxable income of that person, you will get a tax rate.
Yes,
Net
sir.
tax liability divided by total taxable income. This tax rate is known as
Average tax
average
rate.
tax rate. Now tell me, for this person who have the income like 2 million, that person average tax rate will obviously be a high number. So if that person has not included still his interest income from bond, his average tax on the interest income will also be a higher amount. Okay. So people are likely to avoid the interest income taxation. How? Can you recall the last date to register? Last date to
14th December.
Yeah, last date to register, and there is another date, books closed date. Okay.
That was 15th December.
Yeah. If this person can manage to sell his interest bearing securities before this date, before the books close date, that means on the date in which it will be recorded that the person who will be entitled to receive the interest income. So that person has managed to sell his interest bearing securities before books close date, and that that person has sold to which person? Said this person is Mr. A, this person is Mr. B. Mr. A has managed to sell his interest bearing securities on which say 0.5 million interest income will be available. Say just for example 0.5 million. He has sold this his securities on which 0.5 million interest income will be due on this date. He has sold his securities to Mr. B, of whom the income is too low to be taxable. You see, what is his income? 200,000. So say I'm not taking its 0.5 million. Say it is 0.05 million. Now it is how much?
50,000.
0.05 million? Huh?
50,000.
50,000. So if this 50,000 is added to Mr. B's income, will Mr. B need to pay tax on this income?
Yes, sir.
Remember, tax exempted
No.
amount. Can you recall?
Yes, sir. 0% for first 3,000.
Yeah,
300.
in that case, there will be no tax arise. There no tax will arise here, right? No tax will be arose here, right? So
Yes, sir.
Mr. A has sold his securities to Mr. B with a condition that after books close date, Mr. B will return the security to Mr. A. Have you got it?
Yes, sir.
Yes, sir.
Mr. B will return the securities to Mr. A. So when Mr. A is selling these securities to Mr. B in this way, you can recognize that Mr. A will charge a price from Mr. B for this interest income. Say, for example, Mr. A is telling that give me 40,000 or give me 45,000 for this 50,000 interest income. So Mr. B has become agreed. So he will have 5,000 income extra and he is not taxed based on his income. It's a kind of negotiation between Mr. A and Mr. B. Or if it is such that Mr. A and Mr. B are family members. Mr. A and Mr. B are family members. So they have negotiated between themselves that I will credit my securities to your account and you will credit the securities to my account after having this book's close date. So this kind of transaction is known as bond washing transaction. For what purpose?
So to avoid taxes.
Avoiding
Tax.
taxes on
Interest income.
interest income. So it is found, it has been found that people like to practice this kind of transaction to avoid taxes, but it has been mentioned that if it is found that a person has made this kind of transaction just to avoid taxes, he will be charged by the tax authority. You see, by having this transaction, tax authority is not getting any taxes either from Mr. A or from Mr. B. On what? On the interest income. So if Deputy Commissioner of Taxes investigates this kind of transaction, he will charge penalty to this person who are involved in this kind of transaction. Okay. So another thing I like to show you before going to the practice problem, that is when you get the interest income collected by your bank. Say your bank has collected 95,000 interest income on savings certificate. You need to recognize that this some securities tax deducted at source or TDS are available or TDS are applicable for some securities interest income. In most of the cases, TDS is applicable. So what does it mean? If the gross interest income is 100,000, 5,000 tax will be deducted by the issuing authority and 95,000 taka will be credited to the bank account of the SSC. So in that case, don't go for showing the 95,000 income in your income tax return. What you need to do for calculating tax precisely, you need to gross up this income. Remember this term, gross up. So what does it mean? This is a figure after charging TDS, or this is a net figure. So you need to gross up. So how you can go for gross up? If it is mentioned that 5% TDS is applicable here, in that case, you can recognize that this 95,000 taka is not 100%, it is a 95% figure. So if you divide this 95,000 number by 0.95, you get gross amount 100,000. So what is this? This 100,000 is the gross amount. So what you need to do, you need to show this 100,000 taka to the income from interest on securities calculation. So what you will do, this 5,000 tax what you already have paid, you need to show this that you have already paid 5,000 taka. So if your tax due is 15,000 taka on total interest income or total taxable income, for example, now you need to pay how much? 10,000, because 5,000 is already paid. But if you include the 95,000 taka, your tax calculation will become wrong. Okay, so remember the grossing up of the interest income of those securities on which TDS is applicable. Okay, always note the total income, not the net income or the after tax. Always include the before tax when you calculate the tax. Okay, so let me show you a problem so that you have an idea that what kind of rule will be applicable for us. Let me pause the recording, then recording. So what is mentioned here, consider the following income for Mr. Omit Agarwal for the year ended on June 30, 2019. He has several interest income from several type of securities. You see the interest income on government treasury bill, then interest on US dollar premium bond, interest in 10% taxable government securities, then interest on 5-year savings certificate, interest investment in 12% debenture, 400,000, income from 1-year zero coupon bond, 12,000. Be careful that the items which have been mentioned in this list, all of this amount are not interest income item. Some amount have been mentioned as investment amount, but with reference to that investment amount, some percentages have been given to you. So you need to find out how much interest income will be available on this investment. So we will show it. In additional to income from interest on securities as listed in the above table, Mr. Agarwal also has taxable income from salary amounting to taka 750,000 during the year. In line with the Part B, 6th schedule, his qualifying amount for allowable investment amount to taka 150,000. I think you have not forgot that we mentioned the 6th schedule regarding regarding the source of all investment allowance items have been listed in 6th schedule. Based on the information provided, compute taxable income and tax liability for Mr. Agarwal for 2019-20 assessment year. Okay, so let's begin to solve the problem. Like if we clear the canvas, okay. So I think you have got the structure like from previous session, that what we need to write first, SSC name, we need to write the income year, we need to write the assessment year, we need to write the what we are doing. Let's say we are doing right now the computation of income from interest on securities, or but in our case, as the income from salary is given, And the question is not only income from interest on securities, rather the question is income from total taxable income. Okay, compute taxable income. So first of all, interest on government treasury bill. So before that, you need to begin with the income from salary, as it comes first always. Income from interest on securities comes after income from salary. So it has been said that the salary income has been given the final figure to you, taxable income. So what you can do, you can write income from here, income from salary 750,000. So that is the final amount. So let me write it on this direction so that we can have some working for income from interest on securities. Okay. Then we are including the second heading, that is income from interest on securities. First of all, the item is interest on government treasury bill. I have mentioned that treasury bill interest income is tax exempted. So what we are writing, interest income from treasury bill 15,000. As you have come to learn that this is tax exempted. In that case, total 15,000 taka will be tax exempted. Okay. Then interest on US dollar premium bond. Same, we have mentioned that there are some bond issued by government on which US dollar premium bond, US dollar interest income is tax exempted. What is that amount? That amount is 25,000. How much is exempted? 25,000 taka total is exempted. So you may feel that you need to have this bond in your portfolio. So there are some regulation, restriction, or some rules you need to maintain that when you will be eligible to have this bond in your portfolio. Okay. So this particular bond, you see the US dollar premium bond. I will request you to explore more about this. This bond have been particularly issued by the government for the foreign, specifically non-resident Bangladeshi. So who are non-resident Bangladeshi? The people, excluding the concept what we learned from the non-resident Bangladeshi, related to that also, the Bangladeshi citizen who are living outside of the country, who are sending remittance to their country, I mean Bangladesh. And for those expatriate, this kind of bonds have been particularly issued by the government. Okay. One motivation from the government side for issuing this bond is to encourage the expatriates to remit more money in Bangladesh economy, sending more remittance, not only by sending income to their family, also by purchasing bond issued by the Bangladesh government. That is the holistic purpose of government, to attract the remittance. You have recently heard more about news that people are transferring money illegally from Bangladesh, and it's not only by under invoicing or over invoicing, Second source is you probably have heard that unofficial fund transfer. So through unofficial fund transfer, Bangladesh gets deprived of the remittance income, and when Bangladesh gets deprived of the remittance income, that means Bangladesh is not receiving foreign currency. So these bonds particularly attract the remittance earners to invest in this bond and to get the interest income, attractive interest income, and also get the tax exemption facility, so that they will be motivated not to keep their foreign currency with themselves, or they will try to send their foreign currency to their own home country. Okay, so I will request you to explore this bond more, but for our purpose we need to learn that these are tax exempted, and you have got the meaning why tax exemption on this interest income for this particular bonds have been made. Okay, next one, interest on taxable government securities, 10% interest percentage. Remember, this is investment amount, not the interest amount. So you can calculate the interest amount just by multiplying this investment amount by this percentage number. You will get the interest income due in a particular year. So that will be how much? 200,000 multiplied by 10%,
20,000.
20,000. So there is nothing additional mentioned here regarding that whether our SSC has bought this security by borrowing money, or bank has charged some fee on this interest income earning from taxable government securities, or there is no other mentioning that any TDS has been made, tax deducted at source has been made on this interest income. So when nothing has been mentioned, you need to recognize that you need to uh, you can't assume those other things like he has not, whether he has borrowed money or not. You don't need to assume for that purpose. Okay, but if the TDS has been mentioned, for example, in saving certificate, whether it is mentioned or not, remember, in fact, okay, let me write it down first, then I will talk about the saving certificate. Taxable government securities, interest on taxable government securities, 200,000 multiplied by 10%, 20,000. Then no adjustment is needed, but interest on savings certificate, let me write the term first. Interest on savings certificate, there is a rule that 5% TDS is applicable for the interest on savings certificate. So it is from rule. It is can be mentioned in your problem, or it may not be mentioned in your problem, but whatever the figure you get from the problem, you will get, it is likely that you will get figure like this, which is not a rounded number, but whatever you like, you can add a note to explain that what you have done. So nothing has been mentioned, so you need to recognize that TDS is applicable here. That's why 27,000 what has been made as a payment to Mr. SSC Omit Agrawal this 27,000 is not 100% amount, rather it is a 95% amount. So if it is a 95% amount, what we are doing here, can you recall the term what we are doing here? Grossing up. We just have shown to you grossing up. Okay. Now it is the total interest income. How we have got it? 27,000 divided by 0.95.
So
Now next-
28,500 হতো না?
Sorry?
So 28,500 হওয়ার কথা না? মানে 30,000 এ 5% হচ্ছে 1,500. তাহলে ওইটা ডিডাক্ট করলে 28,500.
Let me check the TDS percentage, whether any mentioning here in the problem. Yeah, if it is 5%, in that case 28,500. Okay. So far I can recall that it is to be 5%. So in that case it is 0.95 and it will be 28,500. But remember, TDS is not always 5%. TDS 5%, 10%.
স্যার
it varies.
গ্রস
Yeah.
অ্যামাউন্টটা ঠিক ছিল। সো ইন্টারেস্ট অন সেভিংস অ্যাকাউন্টের পরিমাণটাই হচ্ছে 28,500 হইতো। প্রবলেমেও
Okay.
28,500 দেয়া।
Okay.
Yes, sir.
It is 30,000. Now it is
28,500.
28,500. So from where I have taken 27,000?
সো এখানে 28,500 ছিল, আপনি 27,000 করছিলেন ওটা লিখে জাস্ট বোঝানোর জন্য যে রাউন্ড আপ ফিগার থাকে না সব সময়।
Yeah. Okay, but in our problem it is 27,000. Right?
সো বইয়ে তো 28,500।
But in my text it is 27,000. Which text you are following? Is it
টেক্সটে 27,000-ই আছে।
Yeah, I'm also saying that
Sir, text-এ
27,000.
TDS 10% করা হয়েছে।
Yeah, I know that, but what can I remember that TDS is 5% in case of interest income. Okay.
Sir, 5% হলে 28,400.
Yeah.
421.
421. Okay, let me check it. Okay, so I need to double check whether it is 5% or 10% on interest income, but so far I can recall it is 5%. So to match with the text, let's take it 10%, but I'll confirm it by posting a notification that whether it is right now 5% or 10%. Okay, so here how much percentage of TDS we have taken? 10%.
10%.
Okay. Next one is investment in 12% debenture. Okay. Remember, if it is 10% TDS, that means you already have paid how much tax of TDS?
10%.
In the form of TDS, you already have paid 1,500. Will it reduce your net tax to be paid with income tax return? Because you already have paid something.
Yes, sir, it will reduce, sir.
Okay, then next item is interest on 12% interest on debenture income. You see, investment in 12% debenture, how much? 400,000. So what will be the annual interest income on this debenture investment? 12% multiplied by
48,000.
400,000, it will be 48,000. Okay, interest income on debenture, it will be 48,000. Then income from 1 year zero coupon bond. Can you recall what I have mentioned? Is there any coupon from zero coupon bond? Any interest payment?
No, sir.
No.
No, sir.
There is no interest payment. But so this 12,000 income is has been available in which form to the
Capital
assessee?
gain.
Capital gain. So income from zero coupon bond is also to be included in the income from interest on securities, but remember that income from zero coupon bond has been made tax exempted. Okay. So do you know we have zero coupon bond in our country? There was a SCI zero coupon bond. It has been matured so far I can recall, but recently a new zero coupon bond has been approved. So in that case, it is zero. So what will be total interest income right now? 90?
So 98,000.
98,000. Now what is our task? We need to add this with the income from salary.
Salary.
How much? 750. 750 plus 98. How much total?
So 840.
848,000.
848. Sorry.
So let me write down the tax slab for you. For first 300,000, tax rate is 0%, tax liability is 0. For next 100,000, tax rate is 5%, tax liability is 5,000, right? Okay.
Yes, sir.
Then for next, what is the next slab after 100,000?
300,000.
300,000. Should we write 300,000 full?
No,
Yes,
sir.
sir.
Our total income is 848,000. So up to these three slab, we have covered 3, 4, 700,000. So we need to obviously write down the 300,000. But in next slab, we need to check that how much is remaining to be charged. Okay. Now what will be here?
So 148.
30,000. Okay. What is the next slab?
400,000.
400. So we, should we write 400,000 full or
Sir,
the remaining?
400,000. Remaining.
Remaining.
Let's check. 3, 4, 3, 700,000 is already covered. So 848,000 minus 700,000. So what is the remaining?
148,000.
148,000 remaining. So we need to write 148,000. This 148,000 is within which slab? This 400,000 slab. So what is that percentage for 400,000? 15%.
10%.
So what will be the amount here?
22,200.
Okay, you can write the total tax liability in this way: 35, 7, 47, 57,200, right?
Yes, sir.
It is the total tax liability, but there is a tax rebate available because our SSC has made some allowable investment, right? How much? 150,000. So where is that 150,000? This 150,000, right? Okay.
Yes, sir.
Now we need to check that how can we get the rebate calculation. 150 is the actual. What is the second one? 25% of total income. Can anyone pronounce 25% of total income? Is it? Or there is a condition?
Excluding the reduced tax or tax exemption.
Excluding the income on which tax exemption is applicable or reduced tax rate is applicable. Is there any kind of that kind of income for Mr. SSC in our case?
Yes, sir.
Which one?
10% TDS, government savings certificate.
Yeah, because the TDS, it has been said on savings certificate, this TDS is the final tax liability. So what is that amount of income? 28,500 or 30,000?
30,000.
30,000. So what you need to do now? 25% multiplied by 848,000 minus
30,000.
30,000. Now tell me, what is the figure?
Two lakh 4,500.
2 lakh?
45,000.
I can't listen you clearly.
So 4,500. 2,04,500.
2 lakh 4,500. Is this?
Yes, sir.
Okay. So between these two, A, B, C, 3, which one is the lowest?
150,000.
150,000. This person total income, which is 848,000, is within which limit? 15 lakh or more than 15 lakh? Less than 15 lakh?
Yes, sir.
Yes, sir.
So in that case, which investment tax rebate percentage will be applicable for him? 15 or 10?
15%.
15. So if we apply 15% here on 4,500 or 150,000? Why 150,000? Because we need to pick the lowest
Less amount.
Lower amount.
Lower amount.
So get the calculation. How much?
22,500.
22,500. What is his total tax liability? 57,200.
57,200.
Now, how much tax liability he can happily reduce?
22,500.
So you can understand that the calculation, that how we have applied this rule.
Yes, sir.
Okay.
Yes, sir.
So in for more practice, you can look at the text, two text. There are several problems, but more problems are available, more practice problems are available in shield text. Okay. So now we'll try to concentrate our, spend our remaining time for making some brief discussion on the set of and carry forward of losses regarding regarding the concept. Okay. So is there anyone of whom parents have income from business? I mean, among our class participants, is there anyone of whom their parents have income from business? No one? No one.
So probably not.
Probably not. Okay, but it is very unlikely that we have no income from business. Okay. So you have immediately recognized that you have already recognized that there are it can be several possible sources of income for any particular individual. Particular individual can have income from salary, income from interest on securities, or income from house property, or income from business or profession, these things. Okay. So in a particular income year, it can be such that some of your income are not positive, rather negative. So how it is possible? Say, you can immediately recognize that it is very likely in case of business or profession, or in case of business. In case of business, it is very likely that some years you will have profit, you will have loss in some years. Okay, that means loss, I'm meaning the negative income or negative net income. But is it possible that in income from house property, you will have negative income?
No, sir.
It is not possible by any 2%, 5% probability, 10% probability.
No, sir.
No.
No, sir.
Say you couldn't manage any tenant to live in your house property, but you are maintaining the expenses. You have some fixed expenses for your house property. If you can't
Sir,
manage,
আমিও তো
then
থাকতেছি।
yeah,
I'm still living in that house and that's a
okay.
benefit from the house.
The portion in which you are living, that is not the source of your income. Okay, apart from
Yes,
that
sir.
portion in which you are living, okay, you have a building, for example, you have a building. So which house property I am referring to you? The house property, excluding the portion in which you are living, the other floor where you generate income, and that is the part of income from house property. Okay, so you have some fixed maintenance expense for each of the flat you have taken, or you are giving rent to the tenant. So it is possible that in some months you couldn't manage a single tenant to live in your apartment, and you are maintaining your property. For example, the situation goes on for a particular 1 year. I mean, for a very low probability percentage, it can be such that you will have negative income from house property.
Yes, sir.
That means you are incurring more expenses compared to the income you can generate from your house property. Okay, but
Yes,
in
sir.
salary, is it possible the negative income from salary?
Sir,
By any percentage, 1 or less than 1 percentage?
so I would say no, even though I'm a bit confused, sir. When I lose my job, sir, there is no salary.
Okay, in that case, there is no question of having your salary income. Okay, okay.
Right, sir.
But what I am trying to tell you, that there are some heading of income in which it is likely that you will have negative income or you will have loss. Okay, so it is possible that negative income, say you have income from house property, negative income, for example. Okay, if it is very unlikely to get the picture in your mind, you can think of income from business. Okay, say in your income from business you have incurred loss or you have incurred negative income. So when as an assessee you are paying taxes, what you are doing to calculate the taxable income, you are taking income from salary, you are taking income from house property, interest on securities, income from business, and you are summing all of this income and you calculate your total taxable income. So the thing is that if income from business is somehow negative, just for example, tax authority has given you the facility that you can charge this loss or you can charge this loss against the positive income of other heading. You can charge this loss against the positive income you are generating from other heading. In that case, can you immediately recognize that your taxable income will go down
Yes,
without
sir.
having this opportunity? I mean, when you have this opportunity, your taxable income will go down. Okay, so this facility that SSC is enjoying, that SSC can charge his loss from any income heading with the positive income from other heading. That option or that facility is available as is known as set of loss. Say you have income from business like this. Say you have incurred 50,000 loss, but from your house properties you have generated 1 million positive income or positive taxable income. So what can you do? You can reduce your house property income by the loss from business. In that case, now your taxable income has become reduced. So how this it has become reduced? Because you have set off this loss 50,000 which is from business against the positive income from house property. So this concept is known as set of loss. Okay, if it is such that your positive income from other sources are not sufficient enough to compensate the loss of a particular head. Say you have incurred 5 million loss. Okay, 5 million. So how much income, positive income available here? Say from salary you have 2 million income. Okay, so how much is your total positive income? 2 lakh, sorry, 2 million, 1 million, 3 million. But how much loss do you have to be set up?
5 million.
5 million. So is it possible to set up 5 million loss against the 3 million positive income? It is not possible.
No.
So how much maximum loss you can set off out of this 5 million?
So 3 million.
3 million. Okay. So what is the remaining?
It's 2 million loss.
It is said that this 2 million loss can be carried forward to the subsequent years, subsequent 6 years. Have you got it? Subsequent 6 years, what can you do? You can forward
I can
this
set off the
loss,
loss.
and when you will have positive income here in this subsequent income year, you can reduce your taxable income by how much? the amount of loss you are carry forwarding. If it is such that 1 million loss you have been able to set off in this year, but you here it is not set off actually, it is what you are doing here, you are carry forwarding this loss from previous year. So if it is such that still 1 million is still 1 million of this 2 million loss is remaining to be charged or remaining to be set off, how long you can forward this loss is still you have how many years? 5 years. Okay.
5 years.
Okay. So there are some conditions that how set off is applicable, how the term what I just have mentioned, what is that term? Carry
So carry forward.
of loss. So there are some rules and regulation that how can you set off loss and how can you carry forward of loss. You can follow from chapter 12 of our ICAB text. So say for example, it has been mentioned that if you have income from speculation business, have you heard about the speculation?
Yes.
So for capitalizing a favorite or what I will say that you are expecting that some asset price or some product price will move favorably. Favorably means based on your expectation. Based on your expectation. So based on that, you have taken a huge position, say stock market, based on some speculative thinking, you have taken a good position. So you have incurred a loss. So it has been said that when you generate loss from your speculation business, you cannot set off. Against what? You cannot set off against the regular income or the business income, which is not speculative in nature. Say you have income from poultry business. Okay. Is it a speculative business, poultry business? In most of the cases, it is not a poultry business. Poultry business is not a kind of a speculative business. Okay. So it has been said that you can set off the loss from a speculative business against the loss of another speculative business, but you cannot set off the loss from a speculative business against any other heading or against any other income from business also. Okay, so what can you do? You can set off this loss from a speculative business only from the positive income of another speculative business. So there are some list of rules, the procedure, how to make set off and how to make carry forward of, how to make carry forward. And one of the purpose of this term, you already have recognized that it gives you the opportunity to reduce the tax liability. For positive income, you pay taxes to the tax authority. For negative income or for having loss, tax authority is giving you the facility to reduce the tax liability by charging the loss against the profit or against the positive income from other heading. Okay, so in next session we'll try to see what procedures we need to follow to make the setup of loss and to make the carry forward of loss. Okay, so I like to finish our session